Carrying out a buyout or a buy-in is one of the most complex and important tasks a pension scheme can take. I've spoken to 4 people from the industry who are all experienced in these deals to get their tips on what pension schemes should be worrying about.
You need to consider the strength of the company that's standing behind the promises, because your members might feel a bit let down if you swap what they would see as a very strong company covenant, employer covenant, for an insurance company's covenant from an insurance company that they've never heard of. I've been involved with a number of schemes that have looked at buy-in policies, typically for pensions in payment, and got very close and then at the last moment decided not to proceed, sometimes because of pricing, sometimes because of concern about the insurance company or the provider that was offering the policy, and they felt that maybe they were just swapping one risk for another risk, and that overall the gain probably wasn't worth it.
One thing with the buyout process is you're going to try as far as you can to expect the unexpected, because buyout pricing is linked to a whole range of financial factors. So one thing you need to look at carefully at the end stages of a buyout process is look ahead to those potential bad news dates, like a budget or like monthly inflation figures, which could perhaps bring out bad news, drive prices in the wrong way. And one example of that is last year in the first quarter, towards the end of February, we were looking to close a buyout, looking at the final risk transfer date, and we noticed that the Bank of England's MPC meeting was scheduled for the 5th of March. So we did the risk transfer on the 4th of March, just in case, you never know. Turns out the deal was done on the 4th, and on the 5th the Bank of England announced the start of the quantitative easing programme, which basically over the following 7 days drove gilt yields down around 1% at the longer end. And had we waited past the 5th to seal the deal, that deal wouldn't have happened.
The buyout process is largely driven by data. It is a long 2-year, 3-year potentially process of sorting out every single person's benefits, tracing those people, auditing those people's benefits against a set of rules which itself probably needs further investigation and analysis. Was the equalisation done correctly, GMP equalisation, all of that kind of good stuff. So focusing on the data will take a long time. We've certainly seen schemes recently. It comes into sharpest focus when you find schemes where the insurer is taking on the data risk itself. So trustees will set their own standard for data cleaning, think about it hard, go off and do. Then they pass the bundle to the insurer, who comes at it through a different lens. They're saying, okay, well, we'll run our tests now, and then you get a reconciliation process that can be quite painful because you've got differences of view of as how good is good.
I think for action plan, trustees need to be absolutely clear about how any risk reduction transaction fits into a long-term game plan, and particularly if you're looking at a partial buy-in, for example, it's part of an overall de-risking plan. B is for benefits. I think trustees need to be absolutely clear on the benefits that are covered under a transaction, make sure that there are no gaps in the risk coverage. C for credit risk, obviously transferring one set of risks in a pension plan with a sponsor covenant across to a provider that will have a different credit risk, so understand the security arrangements that can be put in place to help mitigate any credit risk. D for data, I think very, very important. Trustees need to understand the quality of the data in the scheme, make sure it's as clean and as robust as it can be. The consequence being that if it's not clean, then the provider pricing a risk transaction will charge additional margins to compensate for that. So that's an easy win. And E for expenses of asset transition. Again, another easy win. Be absolutely clear that any assets that will be transferred to a provider as part of a transaction are carefully lined up in advance. I think it's you need to be very careful because there are significant margins that can be lost if sufficient due diligence isn't given in advance to that issue.